UK finances are in bad shape, but there are many long-term trends which could make finances even worse in the future. This is the OBR's forecast for government's projected spending and tax revenues, assuming policy doesn't change. Tax revenues are set to decline because people will be buying less petrol, buying less cigarettes, and also less people working. But the big problem really is the projected increase in government spending, largely focused on healthcare, welfare, and pensions. And also these projections don't include the fact that defence spending as a share of GDP may need to rise. And perhaps more worryingly is that there's no sign of economic growth picking up to levels that the OBR are assuming. Last month, economic growth was negative again. It was the fifth time in the past 7 months that growth has been less than expected. It means the UK economy is stuck in an ongoing stagnation, which only puts more pressure on the government's budget. Now, in recent years, UK debt as a share of GDP has increased from 40 to around 100% today. And as a result, debt interest payments have also increased significantly from 42 billion in 2020 to 122 billion in 2023. Partly that was due to higher interest rates and inflation too. But it is a problem for the future. As debt rises, so will debt interest payments. And then it becomes a snowball effect. It got more and more you have to pay. Now, since 2007, the average rate of economic growth in the UK has been declining. This is the declining trend rate of growth. No one really knows when and if growth will pick up. Since 2009, the OBR have frequently predicted that productivity growth will increase back towards its past trend, but it never has. Growth has consistently disappointed. And in the era of increasing turmoil and tariff wars, it may prove difficult to break this. Now, because of low economic growth in the past 15 years, taxes have had to increase as a share of GDP to meet government spending commitments. But, of course, spending cuts and higher taxes itself leads to lower growth. Higher national insurance may be discouraging firms from hiring people, and lower spending and lower investment has been a factor in low productivity growth. Now, it is important to bear in mind that the projections the OBR show isn't set in stone. You can change policy. For example, the government have announced potential cuts to disability benefits, which have been increasing very rapidly in recent years. But the underlying financial situation is still in bad shape for a number of reasons. Firstly, since 2010, austerity has meant public spending has been squeezed from key departments like housing, work and justice. There has also been a cut in public investment, which has led to a backlog of repairs and maintenance problems. Just last year, the National Audit Office stated that there was at least £49 billion in UK maintenance backlog, which equates to around £730 per person. And you can see this in crumbling schools, falling school roofs, potholes everywhere. The maintenance backlog is particularly acute in the NHS, which has seen a constantly rising backlog. And this is manifested in rising waiting lists and appointments cancelled. And it's not just healthcare. You've got court appearances delayed, a backlog of cases to be seen, and a shortage of prison spaces. We could go on and on. And the problem really is, though, that the government would much rather spend this £49 billion not on fixing old problems, but some new shiny projects like building a new railway line to Birmingham, Heathrow expansion, perhaps even helping a struggling Premier League team to build a new 100,000 all-seater stadium. But also, as well as looking at central government, it's important to look at local authorities too, because in the past decade, their spending power has fallen from 64 billion in 2010 to 52 billion in 2021. But combined with a rise in the population and also an ageing population, they are forced to get by with much less. Social care is taking a larger and larger share of local authorities' budget. Just take one example, Hampshire, one of the richest areas of the UK, but they're now spending 83% of their budget on social care. And this is definitely not unique. It's pushing many local authorities towards bankruptcy or cutting core services elsewhere. Now, the biggest growth area of government spending is social security. For example, since the early 2000s, rents have increased, meaning that housing benefits rose quite rapidly. Now, housing benefits have been capped, but this in itself causes its own problems of after housing poverty, and a much smaller share of rented properties are actually affordable with housing benefits. Because some argue that the UK's bad fiscal state is because welfare benefits are too generous. But there are a few things to observe. Firstly, if we compare unemployment benefits to other countries, the UK is not particularly generous at all. Secondly, as a share of GDP, total spending on welfare actually fell between 2010 and 2019. The main working age benefit, universal credit, has been index linked to inflation and subject to a 2-child cap. This has saved money, but also been a big reason for the rise in child poverty in recent years. Since 2000, some welfare payments have kept up with inflation, but when you take into account food, rent and energy inflation, these have often been rising faster than universal credit. So many low-income households who spend a high share on these basic necessities are struggling to meet their needs. And this is basically to highlight the fact that there's no easy cuts to welfare. It's already pretty stretched. It's pretty hard to get by on the UK benefit system. But another worrying development in terms of working age benefits is a rise in the number claiming sickness and disability benefits. The IFS states that 10% of working age adults are now on some kind of sickness benefit. That's 2.9 million on sickness or disability benefits. And this rise in disability benefits creates two problems. Firstly, we've got less people working, and this is costing the economy an estimated £25 billion, something we really can't afford with such low growth. And secondly, of course, it's creating a fiscal pressure of around £16 billion a year. And the UK disability bill is forecast to rise quite sharply in the coming years, largely driven by working age disability benefits. Now, at the moment, disability and sickness benefits are more generous than, say, unemployment benefits. And there is an argument that with very low unemployment benefit, plus the fear of getting sanctioned, it's kind of encouraging people to see if they can find a more secure benefit on sickness or disability. More than half of the rise in disability benefits since COVID has been related to mental health conditions. Though, as the IFS states, there is evidence of worsening mental health since COVID, a 36% rise in mental health contacts in the NHS, 12% rise in antidepressants, and a 24% rise in early deaths due to drug, alcohol and suicide. Hopefully that picture will start to change. Now, another problem for the UK is that the growth of healthcare as a share of GDP in the post-war period was largely financed by falling defence spending. It was a great trade-off. Reduce the size of your armed forces, spend more on doctors and nurses. In 1960, defence was 7% of GDP, healthcare 3%. Now the roles are completely reversed. Defence spending down to around 2%, healthcare up to 10%. But the UK is set to increase defence spending as a share of GDP to 3%, maybe even more. And that will require some pretty hard choices, either increased taxes or less spending elsewhere. Thirdly, whilst working age benefits have been linked to inflation, pension benefits are subject to the triple lock guarantee, which means pensions have risen faster than inflation and faster than other benefits. But not only are pension values going up, we've got a lot more people over 65. As a share of a population, it is going to go up from 22% to around 45% by 2050. And this is the single most important reason for the forecast rise in government spending in the coming years. In 5 years from 2022 to 2027, pension spending is forecast to rise from 128 billion to 171 billion. And don't forget, the state pension is paid out of current taxation. There was never any investment or investment in assets to fund future dividend payments. When you consider the very unpopular means testing of winter fuel allowance only saved around 1 billion a year, it gives you an indication of the scale of spending that is going up and how difficult it is to get a hold of it. In 2044 to 46, the pension age is set to rise to 68. If this is brought forward to 2037 to 39, it would save £60 billion or £8 billion a year, a significant saving. But of course there's a big drawback, and raising the retirement age has a disproportionate effect on low-income households, people with low savings. After raising the retirement age to 66, poverty rates of that age group rose from 10% to to 25%. But if you wanted to maintain the same number of workers to retirees, you would have to raise the pension age to 71 by 2050. A huge jump in the number of years that people would need to work, and of course politically toxic. Another key question to ask is, will the UK see higher productivity growth and higher economic growth in the future, which will enable higher tax revenues to meet these growing spending demands? Now, current OBR forecasts assume moderate growth, but we haven't really seen for quite a few years. Now, if you're an optimist, you might point to things like new technology, artificial intelligence, improved batteries, the potential for the UK to catch up lost ground in recent years, lower oil prices. If you're a pessimist, you could point to a decline in confidence, low levels of investment, a darkening global outlook, and an unwillingness to invest in the UK. Take your pick. By the way, the UK is not alone. You can see similar predictions for other countries. I recently looked at the US. Very similar demographic shift and also a similar surge in government debt is forecast. In fact, if anything, the UK and the US have better prospects than many European and Asian economies, which have even lower birth rates and a quicker decline in the working age population. The whole world, apart from Africa and India, is set to age pretty quick, and it could mean a big rise in global debt that's already been rising in the past decade or so. Now, as regular viewers will know, despite my YouTube thumbnails, don't pay too much attention to them, I am, try to be anyway, a kind of an optimist. So despite all this grim data and forecasts, can we try to put a positive spin on that? Is it really the end of the UK government? Well, firstly, this is not uncharted territory. Debt as a share of GDP has reached 200% in previous centuries. But it is worth pointing out it was a bit different. It was due to a one-off war which kind of ended, and then you can reduce debt. This situation is different in that it's going to be a steady increase, and if you had a shock, a war on top of that, then it would take it up to God knows what. Secondly, the UK does have considerable wealth. It is a relatively wealthy country. At least some of the population are doing well. So maybe as well as all these benefit cuts for working age people, we need to find a way to get higher tax from other wealthy people. Also, although growth has been terrible for the past 15 years, in particular terrible since 2019, maybe finally we'll just get lucky and growth will start to increase again. There is some, in theory, potential catch-up, and there is some high levels of savings. It could cause people to start spending fairly soon if they become more confident. Also, in recent months, the Bank of England has been aggressively reversing quantitative easing, selling bonds back onto the market. At least at the moment, there's a big demand still for buying UK bonds. They could also halt their policy of quantitative tightening, at least until growth gets going again. Also, don't forget that when a society ages, you do tend to see higher savings too. Japan has debt of 240% of GDP, but also with high levels of domestic saving, it's able to fund its debt fairly well. Interestingly, UK savings have actually increased quite a lot in recent years, which is a positive thing. So the UK economy is not going to collapse. But there's definitely a very unwelcome dynamic of fiscal shortages causing lower growth, and then lower growth causing fiscal problems. We're getting higher taxes, but this is also discouraging economic growth too. Same thing with spending cuts leads to lower growth. And on top of that, we have an ageing population, which is pretty dramatic. I mean, in the next couple of decades, the number of people over 65 is going to double. So that's going to require a really big change in the way that we manage the economy. And something we'll have to give. I mean, we've got limited resources and there's only so many pensions you can pay if people aren't working. Also, all this analysis assumes there's going to be no major shock or financial crisis. But although it's impossible to predict the timing, they do happen. And this video looks at the likelihood of a kind of crash or correction in 2025. Anyway, thanks for watching and see you soon.